Despite being in a commodity business, Maithan Alloys has prudently managed its business and has consistently generated superior returns on capital employed. Let's do a three-point analysis to find out if this metal company should be on investors' radar. 1. A quality business managed prudently. Well, the management of Maithan Alloys has been prudent during different business cycles in the past almost 1.5 decades. While analyzing the company's financials for the past 13 years, we noticed that despite the working capital intensity of its business, the debt to equity has remained at an average of 0.7 times and interest coverage ratio at 13.6 times. While there has been volatility in the earnings growth, on a long-term basis, the firm has consistently delivered good growth both in revenue and in profits. The company in the last 13 years period has never reported cash loss. Interestingly, despite a conservative approach, the company's revenues over the last 4 years have grown at 14.4% and profits by 48.3% annually. 2. Where's the challenge? Well, in fiscal year 2020, the company has seen some weakness because of lower demand and lower international steel prices. In the first half of the current fiscal, the revenues have fallen marginally and profits fell 28% year-on-year, largely because of lower realizations. For every ton of steel, about 1.5% of manganese alloy is required to improve the quality of the finished steel. So the pricing power of the manganese alloy is closely linked with the steel industry. Now, thankfully, the steel industry has seen some revival. Steel prices in both global and domestic markets have risen recently as a result of the easing trade worries within US-China. And the domestic steel prices, which had already corrected 15% in the first half of FY20, have also recovered. 3. What should be investors' strategy now? Well, the rise in steel prices is good news and it can possibly reflect in the company's performance and the margins in the second half of FY20. Now, valuations look comforting as Maithan is currently trading at about 55% lower from the highs that were seen in January 2018. At the current market price, the stock is trading at 6 times FY20 estimated earnings, which is very attractive. Now, Moneycontrol Research believes investors can look to accumulate the stock at these levels.